All right, welcome to this new spring enrollment video, and we are going to go over fair value gaps, and especially fair value gaps, how we can understand how we trade back into them, and the relation with fair value areas as well. Now, if we first start off with, of course, a refresher, then we see here the basics, what we went over in the previous video. We went over offering that fair value, that's seeking liquidity again, and how we can then see if we are more likely to offer fair value or seek liquidity by that run or that sweep on liquidity right there. This is, first of all, extremely important to understand before we do anything else. So every video, we need to watch it in the right order to understand it, because otherwise it's just going to mess up the schedule in a sense. Now, right here, offering that fair value or seeking that liquidity, that gives us a target. So how the market moves both give a target right there. Offering fair value, that run on liquidity, and seeking liquidity, that sweep of liquidity, both give us a target right there. So that's important to understand, because if we don't have a target to work with, then of course we're trading in the middle of nowhere. We're trading in no man's land. We want to trade towards a certain target, because that gives us a lot of accuracy, knowing where we can actually look to trade and where we can stop looking for trades as well. Now, when we move towards a certain target, we will create fair value gaps. At least we need to have fair value gaps, because they are also a core part of order flow. So what we're going to go over right here is part of order flow. It's also part of candle signs a little bit. Now, right here, let's see. Fair value gaps. So when we create fair value gaps towards our target, we should always create new fair value gaps off of previous fair value gaps and fair value areas as well, of course. We should create new fair value gaps. So if we're expecting higher prices and we have a bullish order block being created, or bullish fair value gaps, etc., then off of those bullish order blocks, bullish fair value gaps, we should create new fair value gaps going higher. What that looks like, I'm going to show you in just a minute. Then if something happens and we do not create a new fair value gap, no fair value gap right there, if we don't, that indicates that the fair value gap or the fair value area is too weak. The only area we can still trade off of is the liquidity point right there. How do we know if an FVG will create a new fair value gap? On the right side, the 2 candle rejection. That is how we will know if a fair value gap will create a new fair value gap. So a 2 candle rejection, after that, candle signs. So what those 3 options looks like right there is exactly what we're going to go over right now. Right here, we are on GBP New Zealand dollar, and I quickly want to go over the targets. We have this swing high right there on the weekly, and we have the weekly fair value gap sitting right there as well, which on the daily is daily fair value gap sitting right there as well. So those were the closest PD rates, those were the targets right there. Now let's study how we deliver towards those targets. If we take a look at this fair value gap right there, which we can potentially continue higher from. So if we want to continue higher, we can use that fair value gap right there to push higher. Now, what do we actually see? If we study the candle rejection and the candle signs, then we have this swing high right there. That can be an easier target right there. We have the first candle rejecting nicely. Second candle right there is also an up candle. But what did we go over in the previous video versus a sweep versus a run? What do we see? We failed to close above that high right there. And on the lower time frame, that is going to look like a fair value gap not overlapping with that exact liquidity point. So we might be sweeping that high right there. In other words, when we fail to create another up candle right there, an expansion candle of a fair value gap, we failed to create potentially a new fair value gap right there. So here, with this new down candle right there, this becomes extremely suspicious, because now we are not creating a new fair value gap. And will we still continue higher right here? Well, if we do want to continue higher and we are not creating that new fair value gap higher right there, the only place where we can still continue higher from right now is the liquidity point that was created inside that fair value gap. So where a lot of people go wrong is, in my opinion, of course, is when we trade into an order block, when we trade into a fair value gap, we fail to create a new fair value gap higher off of that. And then after that, they still use the same order block that we just traded in. They still use the same fair value gap that we just traded in right there. And they now use the 50%, the 75%, whilst that is almost never the true area that we are truly going to continue higher or lower off of. It's either going to be the liquidity point or it's going to be a deeper retracement in the first place. So in the first place right there, it was a deeper retracement, which we don't need to know if it's going to be the 50% right there. If it's a deep retracement, perfectly fine. But right here, it's going to be the liquidity point that we continue higher off of. So the new discount array that was created inside that fair value gap. The same with the 2 candle rejection. If the first candle does not reject, then the second candle can still sweep that liquidity point inside a fair value gap or an order block to then continue higher. All things we have gone over thus far as well. So a fair value gap, if it has been traded into with the smallest thing, then it is already mitigated. You're not going to use it again, but you can use the liquidity points that are inside that fair value gap. But the fair value gap, we are not drawing it towards the right there and now looking at, all right, can we now use the support and resistance? Because then it just becomes random. It's only the liquidity point that is left behind right there that's relevant. After we sweep this low right there, we can look to potentially continue higher because again, it has the characteristics of sweeping that low. Now, we try to create a new value gap higher. We struggle a little bit. So here, once we do come above that high right there, we struggle a little bit. It seems like again a sweep. Now the drawn liquidity right here is still quite important because then eventually we do still continue higher right there. Now after that, what do we see? We see this new 4-hour value gap right there created as well, which we can trade into to then continue higher off of that. With the new target was that daily fair value gap that we had right there as well. So now I want to go into the lower time frame a little bit to see how we can study this on the lower time frame as well. Now, let's first mark out that swing high that we have on the 4-hour as well, because that can be the eventual target. Let's dive into the 15-minute. And what do we see on the 15-minute right here? On the 15-minute, we have a couple of things going on, where we first of all have a move into this 4-hour fair value gap right there. But if we study this move into that 4-hour fair value gap, what do we actually see? We see this 15-minute fair value gap right there. That's the one responsible for pushing price into the 4-hour value gap. We trade back into that, and then afterwards, we fail to create a new fair value gap lower on the 15-minute time frame right there. Whilst we do create a new bullish 15-minute fair value gap right there as well. Perfect. That's quite interesting because right now that shows us that we might not have that bearish intention anymore because we are not actually creating a new fair value gap. Whilst coming into a discount array where we are expecting higher prices off of. So right here, what do we see? We have this fair value gap and it does not actually get traded back into. Why not? All things we're going to go over later on as well. Afterwards, what do we see? We create this new fair value gap right there. That new fair value gap has a first rejection sitting right there. So the next candle, if it already wants to continue higher, should ideally be an up candle right there, the 2 candle rejection. It does not do that. And it continues lower a little bit. Continues lower into the overlapping defense. All right, it can still continue lower right there into the overlapping defense, into the fair value area to then continue higher off that. That is not too crazy. Now, whilst we do that, we again create a new fair value gap lower into that. So what are we going to do here? Are we going to continue lower off of that 15-minute fair value gap, or are we going to continue higher off of that order block right there? Well, let's see. We sting into that 15-minute fair value gap. First candle, reject. Second candle right now should create a down candle. So this is where it's extremely important to pay attention to the smallest details. And the reason I say that is because when we focus on a new fair value gap to be created, it's extremely important to read every single candle. And what I mean with that is it starts off with the 2 candle rejection, but that's not the only part. Because right here, if we now want to create a new fair value gap, what should happen? Well, a new fair value gap is going to be created right here in, after this candle, we can create another expansion candle right there. And when I refer to the expansion candle of a fair value gap, it's the second candle. So we have 1, 2, 3. That creates a fair value gap. We have the first candle, can do whatever it wants to do. Second candle is going to be an expansion phase. It's going to be an expansion candle. It's the actual fair value gap that's being created. Third candle can be, what we're going to go over, can be a lot of different things. but we need to focus on an expansion phase candle should be created. So right here, we have the rejection. Ideally, where can we now create a new expansion phase candle? Below that low right there. Where if we open up right there, we can create a new expansion phase candle, continuing lower, creating a new fair value gap lower. So right here, what do we see? We have a down candle. All right, well, potentially we want to create a new fair value gap on the next candle right there. So my focus right now is I want to see a new fair value gap being created as soon as humanly possible. That is the goal right there. If that does not happen, I'm a little bit suspicious on price action. I might think that we might not want to continue lower right there. So what do we see? We see right here a push lower, and that push lower actually does what? It reaches that swing low, creates an up candle instead, sweeping that low again right there. That potential fair value area that we were about to create. So what do we do then? Well, this high right there, we see right now, that is a closure above. Where on the lower time frame, that is now signaling a run on liquidity. So the 15-minute fair value gap right there, the bearish one, is not creating a lower price. It's not creating a new fair value gap lower off of that. Okay, and then we can still continue lower off that liquidity point right there. But we are running that liquidity point. We are not sweeping it anymore. So now let's dive into the 1 minute time frame to actually see what is happening right here. And if we go into the 1 minute time frame, then we see interesting price action again. Where what do we see here? We see a lot of fair value gaps being created right there. We have this fair value gap that is pushing lower. It takes a little bit longer to create a fair value gap, but not too crazy. Creates this new fair value gap right there that pushes below this low sitting right there. After this fair value gap right there pushes lower into that low, we create a new bullish fair value gap going into that as well. Where this fair value gap is struggling to actually push lower. The two candle rejection, first candle already rejects, second candle closes above it right there, indicating that we might be sweeping that candle rejection right there to actually continue higher. So what happens? Well, this fair value gap is what we can potentially continue higher off of then, if that's a sweep. Now, what do we see? We create again a new bearish fair value gap going into that. And now let's read the candle signs again. First candle right here rejects. First candle rejects right there. Second candle should ideally already have the opportunity right here when it closes right there or it opens right there to create a new expansion phase candle lower off of that to create a new fair value gap lower. So the opportunity is sitting right there for price to actually continue lower. So this should ideally be a new expansion phase candle in an ideal world, at least be a down candle to create a new fair value gap lower off of that. So what if that does not happen? Well, if we take out this candle rejection right there, then that again becomes extremely suspicious. Right here we see a huge up candle. That in itself is already quite suspicious. We should have already been at least creating a down candle, not an up candle right there. Two candle rejection again. What do we do after? We create new fair value gaps going higher right there. And once we create these new fair value gaps going higher, and we have this fair value gap right there, keeping in mind order flow by now is also confirmed to continue higher after this sweep right there. So this video, I can understand it if it's a little bit overwhelming, because right now I'm going over a lot, but this is what we are working towards. We are now going to combine almost every single little thing that we went over already to see what we actually want to do with price action as well. Order flow, candle signs, sweep versus run on liquidity, it all goes hand in hand. And when you combine everything and you learn to combine everything, which it doesn't have to be straight away, right? It's going to take some time to combine everything. It took me years to do this. So I do not expect you to watch one video here and see, oh, well, we are sweeping this, running this, and this order flow is telling me this. No, it takes time. So allow it to give that time as well. Don't be stressed about that, I would argue. Now, once we want to reach this high right there and eventually want to reach a higher target, which we also marked out, which was sitting right there even, then what are we doing right now on the 1 minute? Well, the 1 minute here, off of that 15-minute order block, so it all retraces back. It's all fractal. Right here, we are reaching into this 1 minute fair value gap. So how can we now actually study how we want to create a new fair value gap higher? A new fair value gap higher is going to be a retracement into fair value gap, into fair value area, whatever it may be at that moment in time. And after that, we have the 2 candle rejection. So here we already reject right there. Next candle, ideally an up candle right there to create an expansion phase. Now, of course, the bigger the first candle right there, the harder it is for the second candle to already create an expansion phase. So what I mean by that is if the first candle is large, very large, going down like this, and we have the close at the bottom and the open at the top, like we see with that down candle, we would need to have a huge up candle right there to actually already create an expansion phase above that. So for example, if we now want to create a fair value gap, we have the first candle. Second candle, ideally an expansion phase. Third candle, not trading back into the high of that first candle to create actually that fair value gap. So what do we see right here? Well, if we now want to continue higher, then above this high right there, the next candle should create an expansion phase candle right there. Perfect. We get that. Okay, if this was already an up candle and it did not create a fair value gap or an expansion phase candle just yet, that's still perfectly fine. As long as the next candle and we create a fair value gap as soon as possible. So ideally in the next few candles, next 2 candles after the down candle, it should create somewhat of an expansion phase higher as well. So here we now have an expansion phase higher right there. Now based on the third candle, we can now see if we actually create a fair value gap and if we want to trade back into that fair value gap, if that fair value gap will actually hold, and if we actually want to continue higher off of that as well. So the first step is right here, we should not trade back into that first candle high because then we are failing to create a fair value gap again right there. So do we trade back into that first candle high? No. Perfect. We have this fair value gap sitting right there. Can we trade back into that fair value gap? That is then the next question eventually. And that is the next few slides that we are going to go over as well. So the goal of this little section right here was purely to train your mind to see fair value gaps that are being created and that are not being created. So for example, when we again look at the 1 hour time frame right here, and we look at this 4 hour fair value gap right there that we can potentially continue higher off of, then a great early sign that we do not want to continue lower is sitting right there, which a lot of people do not pay attention to because, well, they haven't trained their eyes to pay attention to it. And what I mean by that is if we now want to create a fair value gap lower and actually show again that bullish intention that we do want to continue lower, then of course, this should ideally be now a fair value gap, meaning the next candle should stay below the first candle low right there. Because if it trades back into that, it does not create a new 1 hour fair value gap lower, which indicates that we might want to be bullish actually right there. And that is of course exactly what we do not want to see if we expect lower prices, but what we do want to see if we expect higher prices. So that is perfect. So Euro US dollar right here is also a good example to go over. And if we look at this 4 hour value gap right there, we can see that 4 hour value gap never created a 4 hour value gap higher off of that again, where we can see that's quite suspicious price action. So does that mean we're automatically bearish right there? No, but as soon as we then get a 4 hour value gap lower right there, then that should ring alarm bells. That does not mean you should automatically be bearish or bullish, but you should be aware of things. You should be taking into account the probabilities again, the arguments that we are creating. Hey, we are not creating a new bullish 4 hour value gap of that previous 4 hour value gap, but we are creating a bearish 4 hour value gap. All right, the arguments are stating right there that we might actually want to continue lower instead then, where the liquidity sitting in that fair value gap right there actually becomes the target. Now, this 4 hour value gap continues lower, creates new 4 hour value gaps lower off that. The gray box I have sitting right here is a daily fair value gap right there. Now, once we push higher right there, we have this 4 hour value gap. That 4 hour value gap does not create a new 4 hour value gap higher whilst coming into this daily value gap. That's a really good sign. That's a really good sign that that daily value gap might actually want to push lower sitting right there as well. After that daily value gap has been traded into, we create a new 4 hour value gap. That new 4 hour value gap creates very fast a new 4-hour value gap lower of that. Perfect. Whilst also creating a new 4-hour value gap higher of that. That 4-hour value gap higher, what does it fail to do? Well, at this moment in time, we see it again, sweeping that high, failing to create an expansion candle higher right there, then afterwards creating a new 4-hour value gap lower. Perfect. What can we potentially continue lower off of? This 4-hour value gap lower. And if we do not do that, then what do we have? Seek and destroy conditions. Because right there, if we do not hold both sides of the market fair value gaps, we are creating seek and destroy conditions as well. Now, this is a unique example right here because in about, 2 hours, we have FOMC. So there's a lot of volatility, huge news driver coming into the market as well. So that will be interesting to study as well. But just wanted to show you this example. So the fair value gaps right there, and not creating a new fair value gap or creating a new fair value gap leads to a really good understanding. How can we see that again? The 2 candle rejection. The 2 candle rejection after that candle signs. And why candle signs after that? Because we need to understand where can we actually create a new expansion phase of a new fair value gap. How far can we retrace before we create that new fair value gap? Those small little details is all things that are extremely important right there to actually understand. Now from this, we are going to move on towards the next topic, which is, we mentioned it already a little bit when we looked at the 1 minute on GBP New Zealand dollar. And we mentioned, can we now actually trade back into that fair value gap? What will we actually do? That is where the third candle understanding comes in. The third candle understanding is the following. Whenever we create a fair value gap, we have, again, like we mentioned, the first candle can do whatever it wants to do. Second candle is an expansion phase candle, always. Otherwise, there is no fair value gap. Then the third candle is tricky because it can do all of these things right here. It can either pull, it can be balance, it can push. So these are all 3 different options where they all make sense. If we do go into the chart as well, it's visually quite clear on what I mean right there. Now, with a pull, where the third candle is pulling, actually, the resistance is strong. When the resistance is strong, that determines the amount we will retrace, right? What we went over as well. So the third candle is creating a lot of momentum coming into the created fair value gap. Let me show you what this looks like. Here we are on the dollar, and first let's understand the target that we had first. So we were aiming for this target right there lower. Now, whilst we aim for that target, we can eventually aim for that lower target if we do want to run that low, because if we run that low, we can aim for this lower discount array as well. Now, how can we deliver there? We have a weekly fair value gap sitting right there. Once we reach this previous month's low, on the weekly, we can see we are creating a fair value gap lower. And when we create this fair value gap lower, what do we see? We have 1, 2, 3. First candle, doesn't matter, not super relevant on what it is actually doing. The second candle is an expansion phase candle. Perfect. Third candle, what is it doing? After coming into that resistance right there, we are pulling higher. What do I mean with pulling right there? The fair value gap that is about to be created is already pulling that third candle higher. So a fair value gap that is about to be created is already taken into account by price action, meaning it's already pulling, pushing, or being balanced to make it easy for it either to trade into or to not trade into at all, or for it to not hold. Now, when we pull like this and we have a strong resistance, creating a huge third candle higher right there, relatively seen to the fair value gap as well, the fair value gap becomes quite small. If you see where the potential fair value gap could have been created was right here. This could have been the whole fair value gap. And afterwards, not even 10% of that whole fair value gap right there is left over, where the resistance is really strong right there. Once we are pulling that much, there's 2 options. The fair value gap will not hold. That's the first option. The fair value gap will most likely not hold. And we will trade back into an overlapping defense, so the retracement will be bigger, because again, the resistance right there determines the retracement. So if we still want to continue lower right there, then the first thought process should be, I am not too sure if that fair value gap will hold. But if it does want to hold, then it might have a bigger retracement, a deeper retracement into that fair value gap, might come into something like an overlapping defense to then continue lower off of that. How can we then view that? Through, again, more confirmation. All things we already went over as well, but we now need to see it from a fair value gap perspective as well. This right here is extremely important to understand because a lot of people will go into this fair value gap then looking for an entry opportunity that might not be there, because the first thought process should again be, this is not going to hold. And if it is going to hold, then it's going to be a deep retracement like we're seeing right now to then continue lower off of that as well. Now, if you combine this with the understanding of that fair value area, with the understanding as well of that sweep versus that run, then it becomes very visually clear on what we can expect from a certain fair value when we are pulling very heavily. And what I mean by that is, once we reach this target, so it all starts again with a certain target. If there's no target, we can't know what a fair value gap will actually potentially do. We first need to have a certain target. After we reach this target, we see that the fair value gap had the potential, easy potential, to close below this low that we just took, the liquidity point, and creating a fair value gap exactly overlapping with the low. Afterwards, we have quite a huge up candle right there, failing to now create a fair value gap exactly overlapping with that low right there, indicating that that might be an early sweep of liquidity to then target the highs. So this fair value gap in itself is already, should be suspicious. Is that fair value gap going to hold? No, I don't think so. I think the probabilities of that fair value gap holding are already lower. But if it does want to hold, then we can retrace a little bit deeper right there to then continue lower off of that. But if we now retrace too deep, what is that? Well, if we retrace too deep, what will we do? We will create expansion phase candles right there of new fair value gaps going higher to actually target the fair value area high right there instead. So too deep of a retracement at that moment in time is also not good, because then this, when we move below that low and we have a deep retracement, it's more so going to look like a sweep than a retracement of a run to then continue lower. That's why understanding the fair value area is so important right there. A similar scenario right here, this was the target right there, that swing low. We reached that swing low right there with a huge candle like this. Now, once we come into this fair value gap right there, can that fair value gap hold? Well, I would argue it has the potential to hold, but we need to be aware whilst coming into that fair value gap, it's pulling quite strong because we are creating a new expansion phase candle right there already potentially whilst now coming into that fair value gap. So if we would like to see lower prices right there, then ideally not a new fair value gap being created shows us that we might want to continue lower. So ideally on this next candle, we can potentially sweep that high to then trade back into that first candle high to fill a new fair value gap from being created, which indicates that we have more bearish intention than bullish intention right there. So then we can look to actually continue lower. Also, if we don't do that, that becomes suspicious because we have a lot of momentum coming into that fair value gap, which again makes it very suspicious if it will actually hold. Now that is the third candle when we have a pull variant. And as you saw in the last example, of course, it's not only the third candle right there. It is oftentimes the third candle, like the two examples we also went over, but not only the third candle. When we have a lot of resistance going into it, again, the resistance right there determines the retracement, or if it will even hold in the first place. Where in a pull variant, it will likely not hold. Then balance right there. Balance is the nicest one, as in it's the one we want to work with the most, ideally. It's the utopia version. The resistance is balanced, so you don't have a strong pull, you don't have a strong push. Now, if the resistance is balanced, the third candle is a consolidation and setting up nicely to trade into the fair value gap. So what does this look like? Right here, we are on Australian dollar CHF, and we might reach those highs right there after sweeping these lows. Again, we can see the same exact thing right here, right? All things we've gone over. Now, After this, we can also see that we have this new fair value gap being created. Whenever we create a new fair value gap, ideally what we would like to see is the third candle be a consolidation. It's balanced. And what I mean with balanced is it's not pushing higher already, it's not pulling lower, it's not an aggressive retracement already. It leaves behind the perfect opportunity to sting into the fair value gap to then continue higher off of that. Also seen again based on candle signs. So candle signs right there is telling us, well, we are setting up nicely for the next candle to sting into this fair value gap to then continue higher as well. That is exactly what we would like to see right there, because that makes it very easy to then get involved as well on the lower time frame inside that fair value gap. Where another example, if we move a little bit towards the left right here, we see this fair value gap being created right there. Now this candle right there, the third candle, is not necessarily a huge up candle, not necessarily a huge down candle. It's perfect. It's perfectly consolidating a little bit to then, for the next few candles, to sting into that 4-hour value gap to then continue higher off of that. Whenever we have a balanced candle, a balanced third candle where it's not pulling aggressively, it's not pushing aggressively, that is exactly when we can likely trade into the fair value gap, only expect a sting into it, not a deep retracement, to then continue higher off of that. It's also the fair value gap that is most likely to actually hold, and only expect a sting into that right there. So the balance fair value gap, the balanced third candle, is the utopia. It's the perfect one. After that, we still have the push. The push is still tradable, but it's a little bit more difficult to trade that as well. The push is where the resistance is too weak. So where we had pull resistance is too strong, where we have a huge retracement, the resistance is too weak right there. So the third candle is another expansion / rejection, creating a breakaway gap. A breakaway gap is, to first clarify that, a breakaway gap is a fair value gap. It looks the exact same, but a breakaway gap is actually a gap where we do not expect a retracement into. So we already expect us to continue higher or continue lower. This is when the third candle is, just like the second candle in that fair value gap, is an expansion phase candle. A breakaway gap is also seen through a fair value area. So we have two types of breakaway gaps, and I'll go over them right here. Here we are on crude oil, and let's first understand a little bit of what we are dealing with. We were targeting that low potentially to sweep that, to then continue higher off that, to then target the opposing liquidity in the form of that high right there, the fair value area high. Now, if we take a look at the 4-hour, we create multiple breakaway gaps as well whilst coming into the low first. So for example, right here, we have this fair value gap right there. Fair value gap, again, is the same as a breakaway gap, but the breakaway gap is indicating that we are not going to trade back into it before we reach a certain target. That is extremely important to understand. We need to have a target first in order to understand if we will trade back into a certain fair value gap, in order to understand if it is even a breakaway gap. So at this moment in time, we see the third candle right there is already continuing lower again. It's already an expansion phase candle right there. And as well, a rejection again, meaning at the top right there, we have a long wick indicating that we are already rejecting lower right there to continue lower. So is it very likely for us to trade back into that fair value gap before we reach this drawn liquidity? No. And I would argue right there, and I would say, if we do trade back into that fair value gap, it's even more suspicious, because since we do not expect a retracement, it should ideally also not happen, because if it does happen, it's a huge retracement right there to make, where I would then argue again, it might be the pull variant, where we might actually not want to hold that to then continue higher instead. So that is the tricky part about a breakaway gap. You do not expect a retracement into it. And when we do retrace, ideally, you should not want to look for lower prices off of that as well. So eventually, what do? We continue lower towards the target right there on the next candle as well. Now, once we reach those lows, we wait for a sweep, and eventually the sweep happens right there, where we create a new 4-hour fair value gap sitting right there. And we have this target as target again that high. Now, Before, in previous enrollments as well, I mentioned breakaway gaps as a general rule of thumb is when we close above this second candle high right there, that creates a breakaway gap. Just like we saw when we close above the second candle low right there, that creates likely a breakaway gap. That's an extremely general rule of thumb. That is for people that can't read candle signs. And if you are good at reading candle signs, then this is way more in depth. This is way more advanced, because right here, we can also see this is also a breakaway gap. Does not close above the second candle high, but what does it do on the long wick right there, the long wick at the bottom, it already shows that it's already expanding higher. It's already rejecting higher. So is it very likely to now retrace into this 4-hour break or fair value gap to then continue higher? No, I would argue it's much more logical to already continue higher right there instead. So when we have a breakaway gap like that, what do you actually want to do? Well, since we are already rejecting higher, we are on the lower time frame, on the time frame below, already rejecting higher off of a fair value gap that we have sitting right there actually. So right here, these fair value gaps higher that we already create are actually the fair value gaps you want to look to trade off of instead. Instead of waiting and missing the whole move, trying to trade off that 4-hour value gap, which will never be traded back into because it's a breakaway gap. So you go into the lower time frame, into the time frame below it right there to find a new fair value gap. That fair value gap is exactly the fair value gap. After that, the fair value gaps you want to look to trade off of. So those are two types of breakaway gaps, and we also have one for the fair value area. So I mentioned two types of breakaway gaps, but actually we could argue three. Now, once we trade above that high right there and we run that high, what do we actually see? We create a fair value area right there in the form of this right there. This is the fair value area. So now let's understand again, if we are offering fair value, then we should only retrace back towards that high to then continue higher off of that, which leads to this fair value gap right there. And well, exactly this fair value gap right there, the overlapping fair value gap, we can continue higher off of that. Any fair value gap that is going lower and lower right there, and even lower than this right there, and even lower right there, are all breakaway gaps. So the first few gaps that are close to the exact high that we just took, perfect, we can trade back into those. But the lower we go is exactly where it becomes more suspicious, because these are breakaway gaps. Why? Because the fair value area is sitting right there. So we should not have a big retracement anymore. So the fair value gaps that are close to that are actual fair value gaps. We can trade back into that because they are overlapping with the fair value area. But below that fair value area, very deep into that fair value area, we only have breakaway gaps. Breakaway gap, breakaway gap, breakaway gap. So these are all fair value gaps that you do not want to trade off of, that if we do retrace into that, it's actually more suspicious than anything. It's not what you want to trade off of. If anything, you can use those as targets eventually. Because those breakaway gaps, again, you should not expect a retracement into those. So you can see breakaway gaps through when we do have an actual fair value gap in the making and we retrace into that, etc. But we can also see that through the fair value area that we have sitting right there. That is extremely important to understand. So to give you an example right here on GBP JPY, and if we look at this high as a target right there, then since we are already close to the drawn liquidity, we have that consolidation right there, the third candle, the balance candle, which we can already continue higher off of right there. After that, we also see these breakaway gaps right there. The bigger the retracement actually right there, whilst close to the drawn liquidity, is going to be more suspicious. So these fair value gaps, the lower we go, that's not a good bullish sign. As in, yes, we have fair value gaps, but trading back into those is not actually a good sign. The first fair value gap that we see right there it's already a balance. Third candle is a balance, close to the drawn liquidity, should have already pushed higher instead. So once that fails, then these breakaway gaps initially, those retracements are just suspicious. It's not something I would want to trade off of. That is extremely important, again, to understand. So we understand the pull, the balance, and the push, where they are, again, three. We have pull and push, they are two extremes, and then we have balance, which is in the middle right there, which is the ideal fair value gap that we want to have. the fair value gaps you ideally want to trade off of are the balance and in the second. So if it's a hierarchy, the balance is the first one. The push is the second one because you can still make it work. We still have that intention towards drawn liquidity. The third one and the lowest probability is the pull fair value gap. Avoid that one at all costs. And eventually we're going to dive into as well how we can then look for more confirmation. Now, moving on from this, now we need to go over the tricky third candle. And why is the third candle so tricky? Well, let's say, well, like we just saw actually, the third candle, we are not too certain on what it is going to do. So the third candle can pull, can be a push, can be a balance. We are not too certain on what the third candle actually wants to do. We can get an idea of what it wants to do, but it's never 100% certain. We are always more certain trading a second candle of something. And what I mean by that is the following. Here we are on the dollar again, and we can see we have this daily fair value gap lower right there, which we can push lower from, right? But we need to understand, whilst we are trying to push lower off of that daily fair value gap, what are we actually doing? A weekly third candle is in the making. So that weekly third candle can pull, can push, can be a consolidation, can be balance. So that makes that third candle extremely tricky because ideally that third candle right there, if we now expect lower prices off of that daily fair value gap already, we should now see a push third candle. So it should, you are betting on that weekly fair value gap to become a breakaway gap essentially. And that of course is lower probability than if you were to trade just the second candle of that weekly fair value gap. So right here, how can we know actually when we want to stop trading that? Because are we just not going to trade that whole week? We can trade that week, but understand the signs that we might want to continue higher for a little bit. What is the earliest sign? Well, we reject right there of that daily fair value gap. After that, we see that previous day low not getting close below, which on the 4 hour is showing a potential sweep of liquidity right there. As soon as that happens, we have two options. Either it's going to be a consolidation or it's going to be a huge pull. Both is not good for if you want to trade that right there. So yes, of course, a pull might be good to look for longs, but overall, we are not certain if it will be a pull or consolidation. So we need to be very careful right there. So this is the earliest sign. As soon as we start showing signs that we do not actually want to continue lower, we are not running lows anymore. So that is where we need to understand that tricky third candle, because we're never too certain on what that third candle might actually want to do right there. So another example right here on Euro New Zealand dollar, where we have this fair value gap right there, which we, of course, on daily looks beautiful. We can continue higher off that. We still have this swing high as a target as well. So it's understanding right here that whilst we are forming that daily candle and we might get a 1 hour fair value gap already higher. So for example, sitting right there, this 1 hour fair value gap is not necessarily a good trade ID. It's already lower probability. Can you trade it? Yes, you can trade it 100%. Understand, it is lower probability because we are creating a third candle on the daily time frame. We are potentially creating right now a daily fair value gap, which we can sting into to then continue higher off of. So understanding right here, as soon as we get a weird sign, and where is the weird sign? Well, right here, we can simply still look to continue higher. But here we have two candle rejection. Next candle should just already continue higher. Should be a new expansion phase. It's a down candle. Boom, close your trades, done for the week. Wait for that daily fair value gap now to be created. That's it. It's the earliest sign right there where price is not in a utopia anymore. You have big beliefs, as in you expect the perfect price action right there. If that does not happen, get out of the market. You do not want to trade this because before you know it, you are getting caught up in a consolidation right there, and price will just mess around, will not continue lower as well. Why not? Because it's going to create a daily fair value gap. So it will consolidate right there until we then actually push into that to then continue higher off of that. So that third candle is tricky. It's important to understand what to do at that moment in time as well. And the whole reason why I have then stated those time frames is because, again, The monthly time frame is the most important one in this case. If we're trading a third candle of a monthly time frame right there, we need to understand what we are about to do on the weekly, on the daily, on the 4 hour, on the 1 hour. If we are creating a third candle 1 minute time frame, it's not that relevant because we're not going below the 1 minute time frame. If we're creating a 5 minute third candle, all right, it's less relevant than a monthly third candle. So those are all things that we need to take into account right there and understanding the hierarchy of those timeframes as well. Now, next thing is where I want to go over case studies because the cycle repeats. Everything that we went over right here starts with a target. Target is, are we sweeping something? Are we running something? What is the actual target right there? What is the draw on liquidity? Perfect. How can we deliver there? We create fair value gaps towards those targets. Can we trade back into those? Are we creating new fair value gaps off of those? That's exactly where I want to go over the case studies. So the first case study right here is again on Russell. And what do we see? On Russell, we have a daily fair value gap lower right there. And I took this screenshot last night for me. Then we failed to create a new fair value gap lower. So how can we see that again? That second candle right there, or actually the first candle, is getting traded back into. We failed to create a fair value gap lower. So what does that mean? Well, we also come below a low right there. So the liquidity might actually be targeted right there. The fair value gap itself can all be ignored. It's not relevant anymore. The only premium rate that we have right there, the next target, is that swing high. So on the next slide, we see a fair value gap to then continue higher, which is setting up nicely right there to actually continue higher off of that as well. So let's actually look at the chart really quick. Here we are on Russell and we see the exact same scenario right here. So as soon as this happens, we are in the middle of creating a down candle right there and we fail to actually do that. We fail to create an expansion phase of a new fair value gap lower. Perfect. We have a 4-hour fair value gap higher as well after sweeping this low potentially. So that 4-hour fair value gap in itself is what we can potentially look to continue higher off of. Now the question becomes, all right, that 4-hour fair value gap, can we now look to actually create new 4-hour fair value gaps higher off of that as well? So that in itself will be an interesting study. Again, we have FOMC coming in at 2 p.m. So there will be a lot of volatility right there. We'll see whatever it wants to do at that moment in time. Second case study is on Australian dollar, New Zealand dollar right here. And I mentioned we'll reach this draw on liquidity before trading back into the fair value gap. And the fair value gap I'm aiming at is this fair value gap sitting right there. We will not trade back into that. We will first reach that draw on liquidity. Again, that is where we understand, all right, the first candle actually is not too bad candle. As in we can definitely trade back into that. Then we already expand higher. So whilst expanding higher right there, we see lower time frame fair value gaps and find a lower time frame fair value gap to then continue higher off of that instead. So what does that look like? Here on Australian dollar, New Zealand dollar, we have this 4-hour fair value gap sitting right there. And we can see we already pushed higher, did not come into that fair value gap. So as soon as we push higher right there and we are close towards that draw on liquidity, towards the target we had, swing high right there, then on the 15-minute, we need to find a fair value gap. And why the 15-minute? Just work my way down. Do we have a fair value gap on the 1 hour? No. 15-minute fair value gap? Yes. Perfect. We can continue higher off that. Eventually, we see this was the lag right there where I mentioned find a lower time fair value gap. We consolidate a little bit right there. Not the nicest price action. If it was an entry, you potentially would have still been involved. But eventually we deliver towards the draw on liquidity as well already. Now, I was a little bit late to this one on GBP JPY right there, but we have the target and we see right there also a fair value area below that right there still. And we have a fair value gap, which whilst we are close to the target can just have a sting into it to then continue higher as well. The third candle is absolutely beautiful. So the reason why I would only expect right there a sting into that fair value gap and not coming back into the fair value area is because we are already that close to the next target right there. So a retracement all the way back towards the fair value area to then reach the next target, that again would be extremely suspicious. But retracement is not always good. Retracement oftentimes is also seen as suspicious. Why are we retracing that far before we continue higher or lower? That's extremely important as well to, again, understand. So from those case studies and understanding that the cycle repeats, of course, we need to move on to practice because study the target based on the basics. So that target we established in the basics as well. What tells us that fair value area, that seeking liquidity, what does that tell us about the target? Study the fair value gaps toward the target as well. So how do we deliver into those value gaps? Can we even deliver into those? That's important. Now, then on the next video, we will go over institutional market structure. All right, perfect. Thank you.